Good morning, future millionaires. Welcome to a special edition of Crypto News Network. In this edition, we'll be going through the beginner's guide to technical analysis. I've been getting a lot of requests, a lot of newcomers to the market, actually new and don't understand the technical analysis side of things, which is perfectly understandable. We were all new once. These can look a bit daunting to start off with when I first started as well. It just looked like a load of mess, a load of squiggly lines and blurs, and it just looked like a terrible thing to actually get into. But as you actually understand it and you understand the way the market works, it becomes quite a thing of beauty. And the guide here is to make you understand what's going on here and to put all the different elements into action and come out with a reasonable outcome. Again, it's not financial advice, and everything in this video is for entertainment purposes. Now, with that being said, let's get started. So, let's start from the beginning. As I said, this is going to be the first part. It's quite a lot to get through, so it may take one or two parts. Trying to get through it in two parts. We'll start from the absolute beginning, so just in case there are any newbies that are absolutely new to the market, that is perfectly fine. That's what this is for. Don't forget to like and subscribe, please. We're trying to build a knowledgeable community here, so all likes and subscribes will be greatly appreciated. Okay, so what we're going to do now, we're going to start off on Tradingview. Now, Tradingview is probably the easiest way to learn the market. You'll probably start off on Coinbase. Now, the Coinbase charts are very limited. It only basically gives you this, a squiggly line going up and down, which doesn't really tell you much. To get a more in-depth knowledge of the market, you need to actually dive into the actual technicals. Now, Tradingview, you can sign up for a free account. You just go on there, tradingview.com, and it will ask you to sign up for a free account, which will give you access to all the indicators. I think you get around 3 or 4 indicators. That's around how many you need. Sometimes you'll see guys with their screens looking like it's crazy, like a Jackson Pollock picture, just things everywhere, and it's not really that good. I think 3 or 4 indicators is probably enough to make a substantial decision. Again, you need confluence. You need to put maybe 2 or 3 together to get a better picture. You don't ever just go off one. So, for instance, if it was just going up, you'd say, yeah, that's a good time to buy. There's a lot more other things you have to look at in regards to placing your trades. So, let's start here with the candlestick pattern. Just in case you don't know what the candlestick patterns are, there is an excerpt on Wikipedia. I suggest you take a look at it. There are too many patterns to actually go through right now, so it'll probably be best for you to either pause the screen and have a look, or have a look again at your own leisure. So I'll just scroll down for you to have a look in case you want to pause your screen and read them. Okay, but it's probably better for you to go on there and have a look at yourself. But a quick overview is you've got a green candlestick pattern and a red candlestick pattern. Green is good, it's going up. Red is bad, it's going down. Now we'll have a look at them in depth. Well, this is one pre-made, but what you do is you'd go into Tradingview, you'd select symbol search to select your list, and we'd click straight to BTC USD, which gives us the same chart but without all the technicals that I've done before, without the support lines. So now we've just got our Bollinger Bands, which are these ones out here, which I'll explain in a second, and we've got our moving averages, which are here. So this is one indicator, that's another indicator, that's another indicator. So that's 3 indicators we've got there. We've got 1 is our Bollinger Bands, 2 is our moving average, which corresponds to here, and the blue one corresponds to here, our 50-day moving average. Again, I'll explain all of those in a second, just letting you know what's going on the screen. This is our moving average convergence divergence. You don't need to remember that, it's just a mouthful. It just means basically the volume. It's showing you the volume in a visual form. So the buys are in the green and the sells are in the red. So you can just see it by just looking at it quickly, what's going on. To get onto all of these things here, you go into the indicators and you scroll down and you've got your Bollinger Bands there. That's what I've clicked on. And you've also got your, let's see, MACD, that's the moving average convergence divergence. And then you've got your moving averages right here. So those are the three that I use. Oh yeah, and you've also, sorry, the one at the bottom is your relative strength index. That's that one there. The relative strength index is another good visual indicator where you can just look at it and just see how it is in a sort of zigzag form. That's the best way I can describe it. When the levels get to around 90, around here, 90 to 95, these are generally unsustainable levels, so that the price tends to bounce off these levels here. So what you can do is you can come down, you click onto this icon here which gives you your trend line, and you can actually draw a line maybe to the 95, and then you can just continue down, scrolling with your mouse to make it shorter, and you can actually draw that line there. It just gives you a little visual indicator of when it's likely to come down. You can also do another line to the top of these peaks, which will give you another good indicator of when it's likely to bounce, because it's done it before. That's how the markets work. Markets usually retrace and do something that they've done in previous history. That's how you build up your lines of support, which we'll go over in a second. But just as I said, I'm just going over the actual indicators now, because these will be your main indicators on your screen. These will be your go-to point when you first come on the screen, just to get a quick view of what's going on. You can also, to signify that it's going downwards, click on the top of these peaks here. That means that it's respecting these peaks. Every time it hits these peaks, every time it hits this line, it's going down. So that's another good indicator that it's respecting this channel. You can also do the same for the bottom. So you just scroll out of your mouse, keep going as far as you feel comfortable with, line it up, and then just click it. So then that will give you another visual indicator of when it hits below this line, it tends to go straight up again. So you'll always see it trailing, and then it will hit this line. It will generally always go back up again. So it's another good indicator of where the price is. So those are the things that I use straight on the screen. Yeah, we'll go through these ones as and when we get to them. We'll start with the support lines and how the candlesticks work. So let's zoom out a little bit. So you zoom out by scrolling your mouse. Now the best way to look at the market is as a I'd say an emotional reaction indicator. All of these reactions, all of these green candlesticks are all people buying, and all the red ones are them selling. Now everybody's got this information, everybody sees these same things, and what tends to happen is things in the market seem to be self-fulfilling. Now by that I mean, if people start to buy, everybody starts to buy, and if things start to go down, everybody starts to sell. It's a herd mentality when it comes to the market. It's very emotional. So with these emotions, you can tend to find levels of support and levels of retracement of things that actually happen again and again and again, and a repetitive motion. So this is why you get this up-down motion, because it's buyers and sellers reacting off different price structures. and certain price structures hold better than others. So this is where you get your support lines from, because what will happen is at a certain point, there, and there, the price has always reacted. So that is your beginning of your channel, which is called a support line. Now, these support lines are your guide to tell you where the price is going. And what you do is you'd draw a line where it touches at least 3 of these to confirm that it's actually respecting it. So here, you've got your 3 lines here, which are confirming that you're in a supporting channel. Now, you can also do this on the bottom for the lows. So each time it hits a low, and then you draw your line for it to touch the lows 3 times, as you can see. So it was in this channel. Each time it got to the bottom, it reacted and went to the top, and then went to the bottom, and then went to the top. So as you can see, as it got to the top of this channel, it broke down. This was the actual Bitcoin dump a few days ago. As you can see, it dropped out of the channel, and then it's slowly trying to build its way back in. Now, it also respects these moving averages lines. These are another good indicator. When you see it above the red, it generally pulls itself back up again, and that's when it's in an uptrend. And the same for the blue. It wants to be on this side of the blue, that's when it's going up. If it was on the other side, and this flips down, that's bearish. Bearish means it's going down. Bullish means it's going up. Imagine a bull with its horns going up. That's bearish. That means that things are going up. Sorry, that's bullish. That means that things are going up. A bull's horns go up. Now a bear, imagine a bear on 2 feet, standing up with his paws bearing down on you. That is bearish. So that's when they refer to bulls and the bears. Now, this cross here is known as a bearish cross because it is crossing downwards. So imagine the bear pushing down. So if somebody was to say it's looking bearish, that means it's looking downwards. You could also find another channel within channels. Now by that I mean here. You could do a smaller channel here. So then you'd know that it's actually going down. So there's always patterns within patterns. Now we'll delve deeper into the patterns on a later on edition. Again, there's a lot to go through, but that is just the basics of channels. Now you've also got a thing called support, where it's like a channel, but this is where it bounces off on this level, on a horizontal level. So you can see it respects this bit here. So this is where you get your support from. So you can go to this is actually on a daily. You can actually go into different hourly sections. So you can go to 4 hour, where you zoom in closer, you get a better view of what's going on. Or you can get a 3 hour. Now by these I mean every 3 hours it will give you a different reading on here. Now you've got traders in the market that actually will be trading this all the way down to 1 minute, which means that every single minute they'll be betting on the price. That's why you see the price go up and down, up and down, up and down every second like this, because there's traders betting on the minute change, the 3-minute change, the 5-minute change, the 15-minute change, the 30-minute change, the 1 hour change, the 2 hour change, and so on and so forth. So basically every minute of the day there's traders trading on these coins. That's why they're so volatile. That's why they can go up and down at a moment's notice. With the stock exchange, the stock exchange is only from I think it's 9 o'clock till 5 o'clock. So out of those hours there's no trading. With crypto it's 24/7, so anything can happen within the drop of a hat. That's why things can move so fast. Right. So jumping back onto the chart now, if you zoom out, that's when you always get your best view of what's going on. Obviously, if I was to zoom in and look at here all the time, I wouldn't be getting the full picture of what's going on. So sometimes you have to zoom out. If in doubt, zoom out, and then you can get a better picture of how the coin has moved. Now again, I've gone back onto the 1 day so I can get a 1 daily view, and you can zoom out and get a sort of squashed up view of what's going on. Now you can see that it peaked up there, it dropped, peaked up there, it dropped, and now we're going straight up. So that is definitely bullish. If it was going the other way, that way, it would be known as bearish, but it's not. This here, this little slant here, would be bearish. This bit here is bullish. Yeah? Now, another thing you can do, let's just get a bit closer to this. Alright, so another thing you can look out for is triangles in patterns. So you've got these things called ascending wedges, where they're not really closed off into a pattern, but you can also sometimes make triangles. Now sometimes you've got ascending triangles and sometimes you've got descending triangles. An ascending triangle would be something like this. We put this here, there, and then you've got a sort of ascending triangle. As you can see, the triangle is going up. The descending triangle would be the opposite. It would be going downwards, and that would be a bearish sign. But this is a bullish sign, it's going upwards in the triangle. Now what tends to happen is it starts off big in the triangle, and then the price gets squeezed tighter and tighter and tighter until it has to make a decision either to the lower side or the upper side. Now depending on which side of these moving averages it's on, it will generally follow that. So if the 20-day moving average is on the top, it will generally go to the top. If it's trailing below this, near the 50-day, it will generally get dragged below it. So this is why you see here these two are about to cross, and you can see it going down. So another good indicator. This is what you do. You use all these indicators and you put them all together. So again, you can see here, this represents the bounce here. So you can see here in red, and then the green bounce, in red, and then the green bounce. Again, it's respecting this yellow line here. So if you wanted to put a trade there, that would have been a good time to time the bounce, because you can see that it's just about to hit the bounce there. So I know it's a lot to take in, but that's sort of like the basics in structure and support. Resistance. Oh, did I go over this? Yeah, resistance. Resistance is just the top level, so that's the support level will be the bottom, and the resistance will be the top level, the level to which it cannot break. But once it does break that resistance, then you start on the next leg up, and so on and so forth. Now these Bollinger Bands, the green Bollinger Bands are for you. The green Bollinger Bands are for you to guide whether it's going to squeeze out or in. So for instance, when the Bollinger Bands expand, the price will go up. When the Bollinger Bands squeeze in tight like this, it tends to consolidate. Now with consolidation, I mean it goes sideways for a while. When it's trying to find its price, it will go sideways for a while, and then it will either break up or break down. So you get consolidation sometimes for a large period of time, and then it will break up or break down depending on how it's respecting these moving averages. So you can always guide what it's going to do in regards to these moving averages. You don't want to be on the other side, the lower side of these moving averages, because that is an indication that you're going to a bearish divergence where you're going downwards and you're slipping down. You ideally always want to be going diagonally up. That's how you make money in this market. So again, the Bollinger Bands are going upwards and squeezing out, so you know that it's going to be going up for a bearish continuation. It had that squeeze down, and then you open up at the bottom here. Let's take a little zoom in. if you see it start going and hugging the bottom line of these expanding bands, then you know that it's on its way down. So even though these green blocks are going up, it is tending to be underneath these moving averages here. So it is looking like it is probably going to be going down towards this way a bit. If it was on this side of the band and around here, and even in this area of the channel, as you can see, you'd see it's be going up, but it's broken below the channel, and it's actually on this line of support here. It's respecting this support line. Resistance usually turns into support. So the resistance there, where it was hitting it, it turned into support, turned into support. So always remember that the resistance turns into the support. So that was part one. I think that's enough to digest for the meanwhile. I'll get part two ready for you. Any likes and subscribes, please leave a message. I hope this has been informative, and look out for the next part. Okay guys, bye bye.